This is Kali Persall, editor of Institutional Investing and Infrastructure. Joining me today is Jim Hughes, managing partner at EnCap Energy Transition. So we have a series of questions here that really encapsulate the US energy transition. Before we get into those though, Jim, can you just start with a little background on EnCap and what your responsibilities are at the company?
Sure. So EnCap is an over 30-year-old investment manager focused on the energy industry. The origins of the firm are upstream oil and gas. It was founded by the four original founders who came out of commercial banking, did several funds that were credit funds, and then moved into private equity. About 15 years ago, they added a midstream oil and gas investment team. And then 5 years ago, they added the Energy Transition investment team, which is the group that I lead.
Excellent. Thanks so much. So it's great to have you here, Jim. If you can just set the stage for me, where are we at when it comes to the current US macroeconomic background to the energy transition? What are some of your general observations?
I think my general observations would be that given the recent change in administration, increase in interest rates, and sort of the overall macroeconomic backdrop, what we view as the investable opportunity set has narrowed quite considerably from, let's say, 5 years ago. However, the attractiveness of that narrow segment has increased. And we define the energy transition into three broad buckets, which is power, fuels, and carbon management. I think our viewpoint is with this current administration and with challenges related to finding offtake counterparties, fuels is a really difficult place at the moment as an infrastructure asset. We think that ultimately carbon management through carbon capture could be interesting, but we still need a lot of regulatory process. And so the tangible opportunities are relatively thin today. We think it could be an interesting opportunity in the future. In contrast, power is where it's all at. As many people have read, we're in a circumstance where the fundamentals are that we have tremendous excess power demand versus supply. We think that circumstance is going to continue. We think that within the renewables space, utility scale solar is the most attractive opportunity. Everybody probably realizes in the last couple of weeks, this administration has taken a relatively hostile view towards wind. I think time will tell, what that does to the wind opportunity, but I think we see a clear opportunity to invest a lot of capital at attractive returns within the utility scale solar space.
Yeah, that's interesting. So piggybacking off that, what are some of the main demand drivers you see that are strengthening the investment opportunity around the energy transition in the United States?
So we see four sort of demand drivers. One that everybody talks about is digital infrastructure. And everybody tends to associate that with, sort of the birth and growth of AI. But the reality is we have demand for data centers that outstrips capacity irrespective of AI. So we think that the sort of data center demand side of the equation is very strong, very robust, and will continue for an extended period of time. Then we have sort of the industrial policy-driven demand, which is sort of the reindustrialization of the U.S. economy, reshoring of manufacturing, a potential imposition of tariffs. We've seen announcements on semiconductor facilities. We've seen announcements on battery manufacturing. We've seen announcements on solar panel manufacturing, all of which drive significant power demand. Thirdly, domestic energy production. So as we've seen the growth in our domestic energy production over the last decade, we've also seen an increased focus on electrification of that production. So you have lots of oil companies that are using electric drilling rigs, electric frac fleets, electric compression on pipelines. So we've seen in the major oil fields in the US tremendous growth in power demand, most notably in West Texas and New Mexico. In addition, we've had the growth of the LNG industry, which is expected to continue. Again, significant source of power demand. And then lastly, it's the electrification of the economy. I think some question mark as to how fast that will continue under the policies of this administration, but we've seen a significant shift to electric heating. We've seen a shift to electric vehicles, maybe not as fast as people expected, but still material and tangible. And we do think that will continue to a certain extent. So this demand profile, and what's really shocking is power demand in the US had been flat for basically 2 decades prior to that, largely due to significant investment and efficiency. And so we've gone from sort of flat to this tremendous growth rate. It's a challenge for the industry to accomplish that.
Yeah, thank you. So you mentioned a lot here. I just want to go back to digital infrastructure for a second and see what you think about the role that data centers, AI, and the likes of that are playing in the demand that is strengthening the energy transition opportunities. Do you think these types of assets present challenges from a sustainability standpoint, or what are your thoughts?
So the challenge that they present from a sustainability standpoint is it's significant chunks of additional load being added to the grid. Two, they're relatively base load in terms of their demand profile. So when you look at trying to supply that power on an entirely sustainable basis, it's actually hitting exactly at the biggest challenge we have from a renewable standpoint, which is 24/7 flat, dispatchable power. So that's why there's a lot of discussion of nuclear, geothermal, and other technologies like that. Renewables can play a part along with battery energy storage, but it's quite a challenge to supply these large data centers 100% with renewables. And so that's really the sustainability challenge, is the profile of demand, the size of the demand, the suddenness of the demand. All the while, we were all leisurely going along prior to sort of this pickup in demand, believing that all we really needed to do was decarbonize our existing generation fleet. Okay, that's a challenge, but it felt like a manageable challenge when all of a sudden we have to not only try to decarbonize the existing generation fleet, but accommodate significant growth in demand. That becomes a real challenge.
Yeah, that's a good point. So when it comes to these challenges, are you seeing a demand and supply imbalance emerging in the US for power? And do you think renewables, like you mentioned, are they really able to address this imbalance given their relative short development and construction cycle?
So, yeah, definitely seeing an imbalance, and we believe that imbalance is going to exist for certainly the medium term, meaning 3, 4, 5 years, and potentially 7 to 10 years. I think the only way we're going to meet the demand is within all of the above strategies. So yes, renewables, including battery energy storage, will be a big part of the solution, in part because of the short development cycle and short construction times. But I don't think we're going to be able to meet this demand. Our choice is we're either going to have to add other forms of generation to the grid, be that gas, be that geothermal, be that nuclear, or renewables alone can't meet it. I just don't think the resources there. I don't think the practical ability to add it to the grid at that speed and scale. But it will be an opportunity for everybody. Anybody that can get something built is going to have a customer for the power that they produce.
Yeah, thanks for summing that up. So it's becoming increasingly clear that existing grid infrastructure is really struggling to keep up with this influx of renewable sources and that power demand. What are you seeing as the current bottlenecks in the US energy value chain that are threatening to hold back new power generation assets?
So everybody knows that congestion and transmission constraints are a huge issue. Part of the challenge is that the development of transmission is intense from a regulatory standpoint. It's an intense from a land acquisition standpoint. It takes a very long time. We talk in terms of a decade or more in terms of developing major transmission facilities. And that is the interconnect at the local level and then long haul transmission are the primary challenges we had from a grid infrastructure standpoint. We are seeing some market response to that in that we have this dynamic now where historically in the US, you would never have thought when you were considering the addition of industrial capacity or any load, you'd never have said, oh, where can I get power? You would have said, where is the best place to put this industrial facility? As a result of all of the other factors, your supply chain, your customers, shipping, all of those attributes. The last thing you would have said is, where can I get power? That's changed. Data center locations today, just as one example, the first question they're asking is, can I get power in this location? So what we're seeing is a migration of load to where gen is available. We're seeing data center and other industrial development being located where there is generation available that doesn't need incremental transmission to be brought to bear, or where there's resource available that can be developed, whether that's a natural gas facility, whether that's a solar facility, a wind facility. And so it's kind of turned the analysis on its head as compared with where it was historically. We've never really had any meaningful period of time in the history of the US power system where we had to manage scarcity, where we had to manage a circumstance that there was demand that we were not going to be able to supply. And so we're all sort of living through a bit of a novel circumstance. Regulators are, market participants are, investors are, all figuring out how should we think about this circumstance where we have all this demand and a limited ability to respond.
Yeah, that's very interesting how you say this is kind of like a brand new time for a lot of the industry. What do you think can be done about the fact that decarbonization in sectors other than electricity generation and storage have been modest?
I think we're going to have to rethink the incentive structures. The big challenge with liquid fuels that we've observed is you have this giant pool of capital out there that is infrastructure capital. The history of liquid fuel industry is that market participants, the investors in those assets, as part of their investment, they take commodity price risk. That's sort of part of the business. As I tell people, when you invest in ExxonMobil, you fully expect that ExxonMobil is going to be exposed to natural gas and oil commodity price risk. And that's part of why you invest. You want that exposure to diversify your portfolio. Well, the challenge as an infrastructure investor is the history of our business is that you don't take commodity price risk, that you have fixed offtake that sort of guarantees your revenue stream. That disconnect has really limited the flow of capital. There's not been no real willingness on the part of sort of the strategic investors to invest into the space. And infrastructure capital has struggled to find opportunities that feel like infrastructure, i.e., they have long-term fixed price offtake that guarantees revenue. And so I think from a policy standpoint, we sort of have to start over and say, okay, a little bit of a financial incentive is not going to be enough to do this. You're either going to have to use a stick, and the example I give is we tried to use incentives to promote the use of unleaded gasoline for nearly a decade and had made almost no progress until finally the government said it will be unleaded gasoline, and the entire industry changed over in a year. And so it's either going to have to be a stick approach, and there's going to be a significant cost consequence associated with that stick approach, or it's going to have to be some other incentive structure. And I don't really have a great idea other than obviously what I think would be the great solution is carbon pricing, but there appears to be no political will to do that. So I'm a little bit head scratching on what is it going to take? Probably the easiest, but I question whether we have the political will to do it, would be a stick approach, i.e., you will use a low carbon fuel that maybe increases over time. The challenge is we also have to be realistic. If there's a significant cost consequence, there's likely to be consumer backlash, and that's likely to generate, a political consequence. So I think it's one of the bigger challenges. In the meantime, we need to do everything we can to decarbonize those sectors that we can decarbonize cost effectively, primarily power, while also making sure we have enough power available to facilitate economic growth. Because we're already seeing it with this administration. If you can't meet the needs of the economy is going to win out over goals of decarbonization. So you kind of got to let's make sure we facilitate as much development and growth as we can to meet that demand.
Yeah, nicely said. That makes sense. When it comes to asset owners and operators, what impact do you think forecasted power price increases will have on them?
We've already experienced a lot of the price increases. The market structures are very deep and well developed. The regulatory structures are very well developed. So price volatility and an increase in prices, as an industry, I think the electric power industry has the ability to manage that. I think the challenge that everybody's a little bit worried about is you have all of this new demand, much of it digital infrastructure. It is going to get blamed for price increases. And I think we're already seeing a regulatory and government response to that. And so I think we're going to, the history of regulatory system in the US on the power side is we socialize the cost of interconnect across the entire system. And that's really a philosophy that developed 150 years ago. And the goal of that philosophy was we want to electrify the entire country, including remote and rural communities. And we want to socialize the cost of that across the entire system. And it's been very effective at allowing us to build one of the most comprehensive electric networks in the world. Now we have a circumstance where this incremental demand, particularly the digital infrastructure demand, I think people are scratching their head and saying, is it fair to socialize the cost of interconnecting all that new demand across the entire system? And I think you may see evolutions in the regulatory structures and evolutions in thinking that may try to insulate particularly residential consumers, but also small business consumers against increases in power and cost that can be definitively attributed to sort of this new demand. I think and part of the problem is there's no simple answer to that because we have a very complicated regulatory system in the US. It's multi-tiered. You have federal, you have non-jurisdictional, you have state. And so it's a very complicated system. But I think you're going to see a lot of talk and debate about who should bear those increased power prices.